Uh, the topic should include a couple of concepts which will have some mathematical construct, and I think the last one is largely theoretical, which talks about business models. So today's agenda is capital investment and capital allocation part two. I think remember last weekend when we met, we did talk about net present value and internal rate of return as topics, and I think we are going to continue a bit on capital investment and capital allocation today. And then we move to capital structure, where we have a few important theories, specifically from Modigliani-Miller. So there are a couple of models provided by Modigliani and Miller. I think finance world theories, typically and approaches, are given significant importance in the field of finance. So we'll talk about those approaches and their implications. And then I think we'll move towards business models for the day. Perfect. So I think that is the agenda for today's session. Let me just also open up my Excel sheet. We'll need that for some of our discussions. So let me just open that up. All right, perfect. I think we are set with this. Let's move forward then. Now, when we talked about capital allocation and methods which are used to evaluate capital allocation decisions like net present value and internal rate of return, I think it's very important to understand the capital allocation is something that leads to shareholder wealth, right? If allocated correctly and if it is deployed in the right direction. So capital allocation and shareholder wealth are generally correlated to each other. Companies will make investment decisions to maximize shareholder value. They should ideally, right? They will not, it's not necessary they'll always do that, but they should ideally make decisions to maximize shareholder value. And if the return on these investments is greater than the cost of funds, then the wealth is created, right? So I think it's a simple mathematical construct that if you have borrowed money, if you have raised money, let's say at 10%, and if your project return is 12%, the wealth is created. Vice versa, the wealth is destroyed. So the relationship is very simple. Your return on the project should always be greater than your cost of capital. And if that is happening, you are going to say there is wealth creation, you should accept the project. How do you measure the return then? And there are various ways to look at return measurements across the field. I think measurement or measure profitability relative to total invested capital, that is your ROIC, return on invested capital. Fairly simple math, after tax net profit divided by average book value of invested capital. And invested capital is always the mix of debt plus equity, because those are your two sources of capital. Compared to cost of capital, the required return used in NPV analysis is typically the return on invested capital. So if again the return on your capital that you have invested is greater than cost of capital, that would create shareholder value. Otherwise, the value gets destroyed over a period of time. So whenever a capital allocation decision has to be taken, you need to evaluate what will be the return versus what is the cost. If the cost of capital goes up, obviously the return or the profitability of your project will decline. And that is, I think, something that you would have read in economics. Higher interest rates typically lead to higher cost of capital. And therefore, whenever the central banks start raising interest rates, it's perceived a bit negative from a equity market perspective, because the the value of the businesses should ideally decline because their project profitabilities will align lower. So in this case, when we say many companies only issue consolidated financial statements and they do not provide sufficient information to calculate NPV and IRR for specific projects. Yes, it does happen. You won't get project level profit and loss in balance sheet numbers, right? No company typically provides you project level profitability data. So you can't do a project level, return calculation. And therefore, what we typically do, we look at the return on invested capital. And that is your after-tax operating profit upon average invested capital. So a lot of times when people say, okay, if you're taking a return on invested capital and if you're looking at the total invested capital, then you are looking at the entire business. right? The point is you don't get project specific financial information. Because there is no project specific financial information, uh, it becomes practically impossible to do a return calculation on a project basis as an outsider, right? It's always as an outsider to the business you can't do this. If you are an insider to the business, obviously I think you have all the data that you want of the world to work with. So operating profit into 1 minus tax rate upon the average total capital, whether that's your long-term liabilities or debt plus equity. Benefits of ROIC data does not require internal project level data like an NPV or IRR will require. And ROIC explicitly considers capital return or capital required to earn returns, examining both profit margin and turnover as ways to improve performance. So this ratio can be broken down into two sub ratios or two smaller ratios: after tax operating profit by sales and sales upon average invested capital, right? So you can do this profit upon sales, which is nothing but profit margin ratio. This is after tax operating profit margin ratio, and this is sales upon capital, which is your asset turnover or capital turnover ratio. How much are you using your capital to generate sales? So return on capital can actually be decomposed into two ratios, like we did a return on equity when we were doing DuPont analysis, that you can break up your return on equity into smaller ratios, let's say a 3-form or a 5-form ratio. Very similarly, you can break up your return on invested capital also into smaller ratios. The comparison always is against cost of capital, right? The returns always have to be compared against cost of capital. And when we say cost of capital, we mean WACC, more or less weighted average cost of capital, because the WACC will generally be based on both debt and equity financing, right? If you remember WACC, we said WACC, weighted average cost of capital, is nothing but weight of debt multiplied by cost of debt adjusted for tax rate plus weight of equity multiplied by cost of equity. And if you have preference shares, obviously weight of preference multiplied by cost of preference. We generally ignore them whenever we have a discussion, but when we say debt equity, I think implicit assumption is if there is a preferred should also be added into this calculation, because preferred is also a source of capital. So the generic discussion point is, if the returns are greater than cost of capital, accept the project, it will create value, it's desirable. If you want to use a different word, the return can be replaced by ROIC and the cost of capital can be replaced by WACC. So whenever projects are selected in a business, the idea is there should be shareholder wealth creation. Now, it doesn't, as I said at the beginning of the session, it's not always necessary that is going to happen, right? There is a possibility that the management or the company ends up selecting a project which has very bad profitability, or which does not add any wealth to the shareholders. Simple, there are some pet projects. These pet projects uh, are projects which the management wants to, undertake, and it is their, it's sort of, let's say, landscaping of gardens in an office area, right? A lot of people may want to set up beautiful gardens in an office premise, and you spend money on landscaping of gardens. Now, that project may not add a lot of value, right? And that is why we say that's a pet project. Buying an aircraft for a management, and that's not used for business purposes, but for personal purposes. Again, doesn't add a lot of value, but you have spent millions of dollars in buying an aircraft. So certain such projects may be projects which don't add value at all, and they are, projects which destroy shareholder wealth. What is the limitation then of using ROIC? Accounting based measure accruals may lead to significant differences between operating profit versus operating cash flow. Now, because we are working with profit in the numerator, after tax operating profit may not be a great indicator in terms of calculations, because profit is accrual based. while NPV IRR was all based on cash flows. That was cash flow based. That's a drawback. Let's say that's a real drawback, because then you are talking about you know, dependent heavily on accounting. Historical ROIC looks only at the past and is subject to potentially high annual volatility, right? We are looking at historical data, and historical data may not be a great proxy for what would happen in the future, right? And that becomes generally a problem when you're looking at ROIC. ROIC may hide profitable or unprofitable business segments. Now, because you're doing a highly aggregated calculation, you're doing a calculation on a company level. In that case, out of 100 projects, if there are 10 bad projects, in a way, those 10 projects may largely be, not visible, because you're looking at aggregate data. In that case, you don't look at profitable or unprofitable segments. Further, measurement subjectivity. Invested capital may or may not include intangible assets such as excess cash, pension liabilities, or deferred tax liabilities, right? Because invested capital is largely long-term debt and equity. That doesn't mean that it's a bad measure. End of the day, you can use a return on invested capital, but that return on invested capital itself may have certain drawbacks, right? So it's, and we always say in finance, you will not may possibly find a foolproof solution, right? If you go to NPV IRR, you will only find cash flows, but those could be project specific cash flow, right? You can look at, but that data is not available. So your problem there is data is not available. In this case, the data is available, but has its own limitations. So when you use, be aware about the limitations that a specific concept is running on. So what are the principles on which this entire capital allocation conversation is based? And this is where I think you can expect a lot of questions in the examination. The first and a very important principle, after tax cash flows. The entire concept of capital budgeting, as we call it, is based on cash flows. It says accounting measure of profits are less relevant. Consider the tax effect of non-cash deductions such as depreciation. It's accrual versus cash flow. Remember always, right? As we were talking about when we did financial statement analysis, that you could have sales, right, of $1 billion, and you can say, okay, I have generated $1 billion of sales. Now the problem is the the client did not pay anything, right? The client said, I'm going to pay you after 1 month, right? So your cash flow is largely zero. You have no cash flows available. So in that case, we are saying your accounting profit may tell you a good story. The accounting profit may say, okay, you're doing wonderful. But on a cash flow basis, the story is really bad because there's hardly any cash flow available at your end. And I think that is where things become problematic from our perspective, that the cash flows generally are more relevant and more important. You can't do much with accounting profit. Then you need to ignore incremental, or rather ignore, when we say there are certain elements to be ignored, like ignore sunk cost. Sunk cost is not relevant from a capital budgeting perspective. Sunk cost, irrespective of whether you take a project or whether you do not take a project, you select a project or you reject a project, right? Irrespective of the way the project is handled, the sunk cost is gone. You're not going to recover that money. So while doing capital budgeting, any money spent towards, marketing activities such as market research data, collecting information before the project is launched, all that is sunk cost. You've already spent the money, and whether you take the project or you don't take the project, you're not going to recover a lot of it. So any such sunk cost related items need to be ignored, and only incremental cash flows need to be considered. So what do we mean by incremental cash flows? Fairly simple. Let's say Volkswagen decides to launch cars. So let's say their existing car was doing sales of $10 million or cash flows of $10 million. Let's put it that way. The cash flows were $10 million. And now launch of the new car from Volkswagen takes away some cash flows. So this car started generating $7 million of cash flow. And when you are saying $7 million of cash flow, you are saying that out of $10 million, a few customers who would have gone here have now bought the new car, which is my old car cash flows have come down now to, let's say, $9 million. You lose a bit of sales. So the idea is your analysis should only be based on incremental cash flows. How much incremental did you get? You got 7, but you also lost 1 here because of the launch of a new car, typically called as a concept of cannibalization. Your new product may eat away sales of your old products. So the incremental cash flow is only $7 million minus $1 million, which is $6 million. That is what you made, because total of 9 plus 6 is 16. So you are only doing $6 million additional cash flow. And your concept is entirely based on incremental cash flows only. This incremental additional cash flow that you get. Consider cost savings, opportunity cost, and cannibalization effect. Exactly what we were talking about. Consider everything when you're doing a capital budgeting analysis. What will be the cost saving? What will be the impact of, opportunity cost and cannibalization effects? Timing of the cash flow is important. Consider in which period the cash flows occur, their duration, volatility, and any direction changes. So a $10 million cash flow in year 1 is more valuable than a $10 million cash flow in year 10. We already talked about time value of money. That according to time value of money, the near-term cash flows are more valuable than cash flows further or outer in time. So you should always consider what is the duration of the cash flow, when is it payable, will it be stable cash flow, or will there be volatility in the cash flow, right? And factor that in while doing a forecast. Not everything is based on cash flow. After tax cash flows, incremental cash flows, timing of cash flows. Capital budgeting as a concept is heavily dependent on cash flow analysis. But there are some pitfalls of capital allocation, or there are some certain issues that could arise when you're doing capital allocation, classified into cognitive errors and behavioral biases. When we say we are looking at cognitive errors, internal forecasting errors happens, right? And a lot of times when we do forecasting, there is a possibility we have errors. There could be mathematical errors, there could be incorrect formulas, there could be incorrect assumptions. There's a possibility that can happen. Ignoring cost of internal financing. A lot of people believe I have used my money, which was sitting in my bank. I have not borrowed money. Then why should I even take cost of capital, right? The idea is, even if it is your money, even it is an internally financed project in which you are using your own funds, in that case, we are still saying that even in your own funds, there's a cost of capital. If you would have not used that money, what would have been the alternative return on that capital, right? So if it is your funds, which you have deployed in a project, and if you would have not done that, maybe you could have used those funds to invest money. And that's where we say that the cost of internal financing should not be ignored. Improper treatment of inflation. A lot of times while doing cash flow analysis, people forget to include inflation as a factor. And that may give you cash flows which are not appropriate. So this is where we say include inflation as part of all your cash flow calculations. Behavioral bias is anchoring. You anchor your estimates or anchor your cash flow projections to a certain number. And when we say anchoring, you have fixed yourself to that number. You are hesitant to change the number, or you do not want to change the number. So anchoring bias is always there. Maybe you look at a number and you believe that is the right number and you stay put. You forget to incorporate new information or include new information to adjust for biases. Reliance on accounting measures. Yes, we said accounting is always a problem if you're doing capital budgeting, and if you're relying on accounting, there is a possibility you may be not doing it correctly. Pet projects, as I said, management specific projects where the management just wants to take up the project irrespective of whether there is a profitability or not, and not considering enough alternatives. You just simply select whatever comes your way and you don't look at alternative projects, which may lead to missing projects with very good profitability. So when we do capital budgeting, these are elements that we need to remember. And from an exam perspective, I think very important, remember principles of capital budgeting. And you know what, when we talk about cannibalization, like we just talked about cannibalization and we said, okay, cannibalization can eat away sales from my existing product. Cannibalization is also called as negative externality. Basically negatively impacting your cash flows. But then there are also positive externalities, in which case you may have a product which increases the sales of your existing product, complementary product, right? This is a substitute, and which is why you are seeing negative externality. But if you have a complementary product, it can actually increase the cash flows and sales, which is called as a positive externality. Simple example, if you look at the diabetes market, in the diabetes market, there is, typically people who have to be injected on a regular basis, right? And they need an insulin dose on a regular basis. Uh, you typically would have seen there is a diabetic, a lot of people call it the pen, right? It comes, and you can buy the pen and you can just, deliver insulin directly using that pen on a regular basis. And again, there are a lot of companies who make this, like Novo Nordisk makes this, Lancet makes it. There's a lot of companies who are going to make this insulin pen. That pen is expensive because it's cost on the higher end. Now, if you only have the pen, which is a one-time use, it gets expensive for a lot of patients who need it on a regular basis. So how about they launch a refill associated with that pen, where the insulin drug or the dosage could be refilled in the pen. So pen becomes your one-time buy, and refill is something you can do on a monthly basis or on a regular basis. If such things happen, it may increase the sales of your pen automatically because now the pen becomes reusable. So this is positive externality that you can see in capital budgeting or capital allocation. Now, in capital allocation, there's also something called as real options. Like in derivatives, we have financial options. In capital budgeting, we have real options. Real options provide companies the flexibility to make future investment decisions, allowing them to adapt, optimize value, and enhance capital investment outcome through strategic decision making over time. And actually, all of us have real options in our life also. Simple example, you finish your primary education, you have an option to study more. You can go for a secondary education, a higher education, you can go for a graduation, a post graduation, you can add more certificates. Those are all options. It is up to you whether you would like to exercise the option and use your option to study more. You live in a smaller home, you want to now move to a larger home. You have an option to expand your home. And you also have an option to contract the home later, right? If you don't need a larger home, you can also apply a contraction option. So in reality, all of us have certain real options which we live with, and we exercise this based on our requirements. Similarly, companies also have certain real options. Example, instead of making all investment decisions today, a company can wait for new information and decide at a future point whether they would like to make the investments or not. So it's a real option that the company has, and the company may exercise it based on their requirement. This flexibility can significantly enhance the project's overall value, right? And think about it. If you get an option, okay, do this after 3 months when you have a better information available, you may actually then think whether you want to execute or not. Because if execution is going to give you a benefit, you are going to do it. If the execution is not going to give you a benefit, you may not use your option at all. This is exactly like derivatives, right? Put or call option. They give you a right, but no obligation to exercise. You have a right to exercise, but there is no obligation to exercise the option. Example, a company sets up a manufacturing plant today. Once production reaches a certain volume, it may decide to build another plant to process the waste output from the first plant. And it may decide, right? It is up to them. It's their choice whether they would like to set up another plant to process this waste. It all depends what are the commercials then. It's very common in a lot of industries, not specifically chemical industries, but any industry which is dealing with, chemicals, oil and gas. You could use it, or you could have an option to do something else with your outputs. Now, what are the type of real options that we are talking about? The first real option that we are talking about is timing option. Option to delay or accelerate an investment based on market conditions or new information. So both, you can also delay the decision or you can accelerate the decision making. Sizing option. Option to expand, contract, or abandon a project depending on the performance outcomes. You start exploring oil. If you find oil, you would like to expand the scope of exploration. If you find no oil for a period of time, then you have two options. Do you want to reduce your search area or do you want to abandon the project entirely? Maybe you will say, okay, it doesn't look promising. So initially we planned for, 100 hectares. Now let's just try and stick to the most probable area of, let's say, 10 hectare, and then take a decision. What do we want to do? Or you can completely say, I want to abandon the project. So it's up to us in terms of sizing options. Flexibility options. Option to alter operations such as input mix, output level, or pricing strategy. Right? The flexibility option says you have a manufacturing plant that is manufacturing, let's say, carbonated drinks and let's say fruit-based drinks. PepsiCo, right? Carbonated drinks and also Tropicana. So Pepsi may decide based on the seasonal demand that, okay, the fruit-based drinks are not doing great in the market. And maybe it is time to use that assembly line to manufacture more of carbonated drinks. They have an option to change their output levels. They have an option to change anything like a pricing strategy, an input mix, and so on and so forth. You have the flexibility to do it. But if your assembly line is not reusable, it can only manufacture Tropicana, then I think you are losing the flexibility. And then there is a fourth real option, which is fundamental options. The projects that are options in themselves because their payoff depends on the price of the asset, like a commodity. If you are mining copper, the project's profitability is dependent on the price of copper. Suddenly, let's say the prices are very high, you would like to mine more and sell. But if the prices decline for copper, or if the metals prices decline, then you may entirely give up on copper and you may not mine at all, because then you're going to say, I have limited resources. If I now sell at a lower price, it is not commercially viable. So the project itself is dependent on the price of the underlying asset. If the prices collapse, you may just shut down the mining activity for a period of time. The project may come to a halt because now the cost of mining is more than the price at which you are able to sell. How do you evaluate these real options then from a mathematical perspective? Different methods. First, you can do a DCF, a discounted cash flow method. You can straight away calculate NPV. And if NPV is positive and real options add more value to it, the project should be accepted, right? Think about it. If a project is already very good, you're already making money out of it, your NPV is already positive. And if I tell you, you also have an option now, and this option actually is going to make things even better, then there is no second thought. You have to accept the project because the project is profitable. The option makes it even more profitable. You will accept. But when there's an option available, you will have to do certain adjustment. What are these adjustments that we are talking about? The adjustment is specific to the cost of the project. We are saying project NPV will be equal to DCF based NPV, the NPV based on the discounted cash flow method, minus cost of options plus value of options, right? So this is DCF based NPV. Don't think that is a minus sign. That is a discounted cash flow based NPV. So we are saying if let's say the NPV of your project is 100 and the cost of option is 30, but the value of the option is 40, you should accept because overall project NPV is going to increase, right? Options are not going to come for free. There's always a cost associated with option. Now, the third approach is decision tree. Remember binomial trees that we made? So it's very similar to that. We are going to make decision trees. Decision tree analysis means models different possible decisions and outcomes over time. It helps you visualize sequential choices through less precise than option pricing model. So it's not the best, but it is one of the easiest model to do. You can just do a decision tree, which means you can design a binomial tree that if things go do good, this is the value. If things do bad, this is the value. And you can keep doing it till you reach to the end of the project life. And then maybe the weighted average is your answer here. It's like a binomial model, right? And we'll try and do a binomial for a real option. It's used extensively. It's not as if it's not used. It's definitely used to a larger extent. The best, obviously, in this lot is option pricing models, which are based on Black-Scholes or binomial models. They provide a structured way to quantify the value of flexibility in projects. Because think about it, option pricing models are nothing but options based on Black-Scholes, very similar to call price or call or put models. You have an upside or the downside potential to model in it. Now, some of these things can't be done on paper, or some of these things cannot be handled on calculator entirely, which is from an exam perspective, it's very rare, or rather, it's almost impossible to give you a question on option pricing model because Black-Scholes itself takes a lot of inputs for you to calculate. But yes, let's try and do a quick example to understand how real options would add value and how do you take a decision on accepting or rejecting this. In exam, what you can get is a decision tree, example. So decision tree and the adjusted NPV are the two methods you should be aware about. So I think these are the two which could be tested in the exam, adjusted NPV and decision tree. Let's do an example, as I said, for adjusted NPV. P&G is planning to set up a new shampoo production facility with an estimated NPV of cash flow as negative 2.5, right? So you are saying that the NPV of the project is negative $2.5 million. Project is already making losses. At this stage, the company is also toying with the idea to install another $2 million worth of equipment, which gives it a flexibility of producing 3 more variants of shampoo in the future based on demand. So what is your investment? The additional investment that we are talking about is $2 million. And as soon as you do this investment, you have an option in your hand, and that option is flexibility of producing 3 more variants of shampoo in the future. That is the option that you have. The option of producing variants of shampoo has a value of $5 million. So you are saying this is my investment, or what is also the cost? What is the benefit? The benefit of doing this is you are going to get $5 million of incremental value. So what is the profitability of the project, including the option? You're going to say my adjusted NPV is NPV before taking the option plus the benefits minus the cost. So effectively you are saying a project which had a minus $2.5 million negative NPV, which I would have rejected, by adding an option gives me $500,000 of positive NPV. So till the revenue or till the benefit is more than the cost, and it adds value to the project, you would include it as part of your mathematical calculations. So this is how an adjusted NPV would largely shape up. You're going to say that adjusted NPV for this project is positive, and therefore the project should be accepted. Let's look at an example using a decision tree. So when we say a decision tree, we have a lot of information here. We are saying a corporation is considering 500 million euro of outlay. This is to capital investment for a facility to produce a new product. In 1 year, there's a 60% chance of a successful product, or with a 750 million return, and a 40% chance of a product failure with a 0 return. Fairly okay. This means your expected cash flow is 60 into 750 plus 40 into 0. Assuming a product failure in 1 year, then 1 year later at t equal to 2, there is a 30% chance of an alternative product launch with a 600 million return, a 30% chance of a sale of another firm, so another sale to another firm with 400 million return, and a 40% chance the facility will be abandoned with a 0 return. So we need to calculate the project's NPV without real options using a 10% required return. And then we should also try and understand what is the value with an option, right? We should also try and do a calculation with an option. So let's put this on the Excel. Okay, let's quickly write down the data for all of us. So data is probability of a successful setup is 60%. Probability of a failure is 40%. Returns 750 million and 0. Okay, so those are your return numbers. So this is your success scenario, this is the failure scenario, and this is your probability. Now, let's say this is without option. What is your investment today? You are saying I am making an investment of 500 million euros. So that investment is 500 million. Cash flow at time equal to 1. How much am I going to get? A 60% chance I get 750 plus a 40% chance I'll get 0. So my expected cash flow is 450, right? My expected cash flow after year 1 is nothing but a mix of the probability multiplied by return. So you are simply saying 60% chance you get this, 0% 40% chance you get 0. So your total expected cash flow is 450 million euros. So what is the NPV on this? You can use your calculators or you can simply do. And what is the return we are looking at? The required rate of return. The question says is 10%. So you are looking at 10% return minimum on this. So if you do it on your calculator with only one cash flow also, it should be very easy. 10% value of the cash flow subtracted investment. You are going to lose 90 euros on this project. Effectively 91 euros is what this project is going to burn for you. So this is, I think, answer number 1. This is the NPV without option. And if you look at the project without option, you are going to reject the project because the NPV is less than 0. The net present value is less than 0. Simple way to look at this is present value of this cash flow. Present value of this cash flow is 409, right? We have discounted 450 by 10% for 1 year. 450 by 10% for 1 year. This is my present value of cash inflow. From this, I should subtract my investment and I will get the same number. Okay. So present value of cash inflow minus investment. Perfect. So we'll reject the project if we are solely based on this criteria where we are saying that the return is purely based on what is the project's value without an option. Now let's do this with an option. Let's say there is an option available for us to take use of. So let's write the data for option. We are saying there's an option available and the option is saying there's a 30% chance of alternative product launch, 30% chance of alternative product launch, another 30% of a sale to another company, which means you will go for a merger or acquisition activity. And there is a 40% chance the facility will be abandoned. Right? The 40% chance the facility will be abandoned. So there is a 40% chance of abandonment. If this is the probability, your returns are 600, 400, and 0. So you are saying this is 600, 400, and 0. And this is all at time equal to 2. At time equal to 1, you already know there is a failure, right? So we are saying if there is a failure at t equal to 1, then at t equal to 2, this can happen. You can launch possibly another product, make some money, sell your business, make some money, or close the facility and zero return. You have this option. Do you want to go to time equal to 2 and use your option? So now we are going to do the same thing. We are now going to say, I'm investing 500. At t equal to 1, I'm failing, which means my returns are 0, right? Failure. But at cash flow time equal to 2, same concept. At time equal to 2, this is my probability into return mathematics. So at time equal to 2, I have 300 million. But remember that 300 itself has a probability. So you are saying this is what is going to happen. But what is the probability of this 300 euro happening as an expected cash flow at time equal to 2? So you're going to simply say the probability of this happening is 40% because failure. So what I'm only going to make is 120. There's only a 40% chance failure happens. And if failure happens, I'll make 300. So in aggregate, the probability adjusted cash flow is 300 into 40% at time equal to 2. So let's do a present value of this. This divided by 1 plus 10% raised to the power 2. 99.17. And now you are saying if I have a project without an option, but if I have an option, the value of the option is 99. This means if I wait for one more year at time equal to 2, I may have some positive value. And this positive value makes your adjusted NPV greater than 0. NPV without option plus option value minus option cost. In this example, we have not been given option cost. So we are simply saying this is equal to NPV without option minus 90.91 plus value 99.17 minus 0. I have not been given any option cost. So this becomes my adjusted NPV. And now a project which you were losing has suddenly turned profitable if you exercise your option or if you use your option. Make sense? Questions? Anything on the decision tree? So on the decision tree, remember we have adjusted for probability also. Perfect. Now, this actually could be visualized using a tree also. So you can simply visualize it this way. You can simply say at the start, I'm making a 500 million investment, and from here, there's a 60% chance of a profit, 40% chance of a loss. But if there's a loss, there are three possibilities. There is a 30% chance you will make 600. There's a 30% chance you're going to make 400. There's a 40% chance you're going to make zero. If there is a 60% probability, there's only one chance you'll make 750. Right? There's a 100% probability of making 750. So if I ask you what is the value of the project using this, you just have to navigate the tree here. You will say, let's make an investment, and maybe this happens. Things go bad. If things go bad, and if I wait for year 2, I may get 300 here, weighted average of this. But that 300 I'm getting is only a 40% chance, so I'm going to get 120 here. And 120 discounted by 1 plus r raised to the power 2. So you can always do a decision tree. And decision tree is something that is expected in the examination. Okay. 90.91 and value of real option discounted probability discounted by 2 year 8.26. Perfect. So I think that is the first part of our reading, which is the capital budgeting remaining portion. Questions? Anything? No? Okay, all good. Perfect. Good then. Just give me a couple of minutes. I'll just get a glass of water and I think we will get started with capital structure. Just 2 minutes and I'll be back. Okay, perfect. Good to start then on capital structure. Now, when we say capital structure, it's a decision for a company to make how much debt and how much equity do they want in the business. So how much money do they want to borrow and how much money do they want to put as an equity capital in the business. This decision of the mix of debt and equity is done in such a way that your cost is minimum. Your cost of capital is minimum, because the lower the cost of capital, the more is the value for the business, right? So to maximize the company's value, you need to minimize the cost. And what type of cost? Cost of capital. Nothing but wacc, weight of debt, cost of debt, 1 minus tax, weight of equity, cost of equity. So when they say D by V and E by V, V is the value of the company or value of the capital, right? It's more more appropriate to call it the total capital. Debt plus equity is the total capital. The cost of capital is considered as the marginal rate, that is the rate that will be paid for any additional amount of funds raised. So we would like to minimize this cost. Now, what are the factors which affect the capital structure and eventually the cost? First factor is company's life cycle. Early stage companies typically have a higher cost of capital. Why is that the case? Early stage companies generally have a higher amount of risk. They may be struggling on their product development. They may not find the appropriate team members. They may not get money to make the product commercial. They may have competition issues, several things. For a company which is into early stage, the cost of capital is significantly higher versus late stage companies or typically mature companies where the cost of capital is lower. So the company life cycle impacts your cost of capital, and that is also impacted by capital structure. So when we say capital structure, for early stage companies, there's hardly any debt available, right? To startups, not a lot of people provide debt funding. Most of the startups typically get equity funding, and equity as a cost is more than the cost of debt. In general, the cost of debt will always be less than the cost of preference shares, and that will always be less than the cost of equity. So the reason being, risk is least here and risk is the most here. So because lower risk, you get lower returns or lower cost. Highest risk, highest returns or cost, and in between is a sandwich security like a preference share. So the capital structure determines is based on life cycle, cost of capital, because equity is expensive. A lot of people like to take a bit of debt. Financing considerations, how easy is it to raise money? In certain geographies, is it easy to raise equity capital than debt capital? So if you think raising equity capital is relatively easier, then you will go for raising equity, because raising debt inherently becomes more difficult. Competing stakeholder interest. Competing stakeholder interest is also important to assess, because the debt holders would always think for a lower risk, while the equity holders would always like to take more risk because they are taking higher risk, they want higher returns. And that is why the structure of the company's capital is also relevant. Will the debt holders allow you to borrow more debt? If I've already given you money, will I allow you to borrow more money? Or will the equity holders be okay taking significant amount of debt, or even okay diluting more shares or diluting stake? Will the equity holders allow you to sell more shares? So there are always competing stakeholder interest that impacts your capital structure. And then one very important factor here is also taxation. Debt offers tax benefits, while equity does not offer tax benefits. Therefore, in the cost of debt, if you remember, we multiply by 1 minus tax rate. We take the pre-tax cost of debt, multiply by 1 minus tax rate to get to the post-tax cost of debt. And that post-tax cost of debt is something that we use in our wacc calculations. So sometimes your cost of debt also, or your financing is also dependent on the tax benefits associated with it. Now,
Yeah,
talk.
please,
Yep.
would you mind just to go
Yep.
back? Yeah, in the last factor, competing stakeholder interest,
Mhm.
um, we can also talk about the shareholders against the majority of shareholders that control the company and the minority interest here as well.
Absolutely. Within equity also, there are majority and minority, as you say. So
Okay,
within equity also, there could be conflict. The controlling shareholders may want something else, while the minority shareholders may want something completely different.
all right.
Right? So that's always a conflict between, and that's, I think, what we discussed when we were doing corporate governance, that between stakeholders there could be conflicts, which which may lead to an optimal decision or a suboptimal decision depending on how things move. So from our perspective, when we are saying company life cycle or cost of capital considerations, the idea is, we've talked about startup, mature, unique businesses. WACC is something that we focus upon. And the equation is not something which is too difficult. Equation we have talked several times. The idea is you're using after tax cost of debt, which is adjusted for tax rates, and market value weights for debt and equity. What do we mean when we say market value weights of debt and equity? Which means ignore the balance sheet numbers, because the balance sheet may not be fair value. For example, on your balance sheet, equity is, let's say, 100. That is historical value when you sold your shares maybe last year. Today, the fair value of your equity is, let's say, 120. So this is the market value of equity. This is the book value of equity. Ignore the book value, take the market value in your calculations. So if I say the debt is 20, then your weight of debt should be 20 upon 120 plus 20. You should take market value of equity in your calculations. And similarly, market value of debt. If market values are not given, you can take book value, but the priority is always market value weights. As always, you should add preferred if it is available, cost of preference shares multiplied by weight of preference, right? So that is something I'll leave for now. When choosing between capital structures, choose the one that minimizes WACC, and if possible, match the liquidity or time horizon of the investment. Now, it's very easy to say that choose something that minimizes WACC. Intuitively, a lot of people will say, because cost of debt is lowest, shouldn't a company only raise money via debt? Because the cost of debt is lowest, take the lowest cost here and put 100% on the weight of debt. That should intuitively give you the lowest weighted average cost of capital and highest value of the company. But that isn't correct, because one, bankers will not give you 100% loan. They will always want some money which is your own money. What do we call as skin in the game? If you have your money in the business, you will work towards safeguarding that money or growing that money. And the second thing is, if you keep borrowing from 10% to 20% to 30% to 40% debt, the interest rate on the debt will also start increasing. Your cost of debt will keep increasing because now the new debt holder is also facing a risk. So the first time you borrowed, someone gave you the loan at 7%. Then you went to borrow again, the loan was 8%. Then you went to borrow again, the loan was 10% because the risk increased every time you borrowed. So in a way, the cost of debt also keeps increasing if you keep borrowing. Quick example, a company's capital structure is 30% debt, 70% equity. The jurisdiction allows a tax deduction for interest expense. Debt investors require a before tax return of 6%. And the equity investors require a return of 12%. Calculate the wacc with a marginal tax rate of 20 and 25%. That is the only difference in the two calculations. From a computation standpoint, nothing great, but I think from a conclusion perspective, the cost of capital reduces if the tax rate increases, because the interest provides you tax benefits. The increase in tax rate causes after-tax cost of debt to decline. Therefore, your overall weighted average cost of capital declines by 0.09%. And remember, no such tax benefit is available on equity. It is only available on debt. Another example, a company's balance sheet shows $400,000 in bond and $600,000 in common share, 40,000 shares outstanding. Total liabilities and equity are $1 million. Current stock price is $20 per share. Required before tax return on debt is 5%. Equity is 10%. Calculate the wacc if the stock price rises to 25 and relevant tax rate is 20%. Give it a try. Give it a quick try. Actually, give it a try with $400,000 in bonds, 600,000 in shares. Yep. The question should have had a different number, but that's fine. I think let's just solve with this and I'll explain you why I think the question should be framed with a different number. Give it a try. Take 3-4 minutes. I think more than enough to solve such a question.
$7.6.
7.6? No. Let me just try and do this. I don't know what is the number. It should be somewhere around 8, 9 in between that. Let me just. Let's see if there's any other number available, but quickly. So, sorry, what is the question? We have company balance sheet shows $400,000 in bonds. Perfect. So the debt is $400,000. Shares are 40,000. Price per share. We're going to take the fair value of equity. I think if that
Okay,
is
I ignored
the
it.
show, yeah.
I
Maybe you've worked
ignored
it
it.
on a book value.
Yeah. That's it.
Perfect. I think no problems. I think that's absolutely fine till we keep doing it in here, not in the exam. But yeah, that's your debt, and therefore your fair value of equity is 40,000 into $25 a million. Weight of debt, therefore, should be $400,000 divided by 400 plus a million. And weight of equity, therefore, will be 1 minus this. Right. So this is nothing but 400,000 divided by 1.4 million, which is this total capital. And then I think it's fairly simple. Once you have the weight of debt and weight of equity, cost of debt you have been given at what number? 5%. That is before tax. Tax rate has been given 20%. And cost of equity has been given at 10%. So cost of debt after tax, cost of debt, pre-tax or post-tax, whatever you want to call it, before or after, into 1 minus tax rate. And now the math is fairly simple. You will have a weight of debt of 29% multiplied by post-tax cost of debt of 4% plus weight of equity multiplied by cost of equity. 8.28 or 29%. Right. So always remember fair value of equity is what we are looking at. If you work with a book value of equity, yes, I think that's where the numbers was 7.6%. But don't ignore the book value of equity. If fair value is not given, book value is the only possible answer that you can derive. So this was the only difference that we had to factor in. $1 million of market value of equity or fair value of equity adjusted for. What is the number? 8.29. Okay, perfect. Yeah. So if you're going to do it pinpoint decimal numbers, 8.29. This is, I think, because of the rounded off numbers used here. Questions? Anyone on the calculation? And which is why I say in level 1, actually, the mathematical calculations are fairly easy once you understand the concept. There's not much for you to worry about. I reiterate and repeat every time I meet you guys that the differential or delta would be theory. Oh, yes. So top-down factors affecting cost of capital, financial market conditions are also important here, right? If the market is into a recession or the financial markets are into a mayhem or a collapse-like situation, cost of debt will typically increase, right? Because this includes a spread to cover issuer-specific risk. Increase in interest rates, recession, default risk, all will increase the cost of debt. And higher stock prices will typically decrease cost of equity and encourage equity issuances. So if your equity market is doing good, right, which is where you have higher stock prices, then more people would like to do IPOs. And initial public offer means you're selling your shares, your equity issuances are going higher because the cost of equity is looking cheaper right now. People are ready to buy shares at a in a very good equity market condition. So the idea is capital market expectations or capital market conditions also determine what is your cost of capital. Industry conditions, the nature of the product or service sold by the company determines cost of capital. For companies with more tangible assets, the cost of capital is relatively lower. But for companies with intangible assets, the new age businesses, AI, platform, all of these companies will have usually a higher cost of capital given the risk associated with the business. But yes, if the industry is doing good, your cost of capital would generally be lower. But if the industry is going through a turbulent time period, the cost of capital may tend to increase. Issuer specific factors, what we just saw were market specific factors. Financial market conditions and industry conditions are not something that is in the hand of a company. A company cannot change anything there. But what a company can control is their own factors. And their own factors include factors associated with sales, profitability, financial leverage, and collateral or the type of asset that you own. So if the business is facing risk on account of sales or profitability, that is a risk that the cost of capital will showcase. The cost is going to increase. If there's more leverage, the cost is again going to increase because the company is riskier. Or the collateral and type of asset owned, right? If you're going to offer liquid collaterals, fixed deposits, gold, treasury bills, treasury bonds, that will reduce cost of capital. These are very, very safe collateral assets. But if you're going to offer collateral such as, equity securities, or you're going to offer collateral such as real estate properties, these can lose their value, right? In such case, the collateral is not very strong and there is a possibility your cost of capital may be higher. The cost of capital is dependent heavily on leverage, as we said, right? And leverage again can be bifurcated into two categories: operating leverage and financial leverage. Now, operating leverage and financial leverage are a couple of very important elements in the field of finance. And most of the businesses, when you study them on operating leverage or financial leverage as a concept. So you try and explain whether the business enjoys an operating leverage or not, whether the business enjoys a financial leverage or not. Take example. Let's first talk operating leverage. Two companies are 100% equity finance, which means there is no debt. Each company has a revenue of 100 and expense of 70 for the year. The only difference, the expenses are the same, but the only difference is one company has fixed cost 50 and variable cost 20, while the other company has fixed cost 20, variable cost 50. So we have just made the proportion of cost different, fixed versus variable. The operating leverage concept is based on fixed cost. Simple way to remember this is higher the fixed cost, higher the leverage, higher the operating leverage. And higher the operating leverage means if sales increase, your profit increase will be magnified. You will get the benefit of it. But if sales decrease, the loss will also be magnified. So if you enjoy operating leverage will have both sides. It is going to magnify your profits and magnify your losses also. And the leverage is dependent on fixed cost, which is why we'll prove mathematically that a company which has higher fixed cost has the benefit and the disadvantage of leverage. Equity for both companies is 100 because there is no debt, 100% equity financed. Both companies have a profit of 30 and ROE of 30%, right? 100 revenue minus 70 cost, 30 profit, and profit divided by equity is return on equity. Right? Return on equity is profit divided by equity. They are 100% equity financed. We have to assess what is the impact on ROE for both companies of a 25% sales increase and a 25% sales decrease, and which company is likely to have a lower cost of debt. First, this is company one, which had 50 fixed cost and 20 variable cost, which means variable cost was 20% of revenue. 20% of revenue. So if the sales decline 25% and if the sales go from 100 to 75, your variable cost also declines. 75 multiplied by 20% is equal to this. Your contribution is that the difference of the two, 60. Fixed costs don't change. Profit 10. Return on equity 10%, which means 25% sales decline and your return on equity has fallen from 30% to 10%. That is 67% decline in your return on equity. But if the sales increase by 25% from 100 to 125, this multiplied by 20% is your cost of goods sold or variable cost. 100 contribution, 50 fixed cost, 50 profit. Your return on equity magnified by a similar ratio, right? You've grown this by 67%. So we are saying 25% decline, 67% drop. And percentage wise, I'm talking percentage wise. Otherwise, 20% drop here and 20% absolute increase here. Now, look at the same data for company 2. Company 2 also saw the same thing, but their variable cost was 50%. So their variable cost was 50%, variable cost also went up. Their fixed cost was only 20, and therefore for them, the loss was also smaller, the profit was also smaller. They did not go to 10%, they did not either go to 50%. Because their fixed cost was less, their operating leverage was also less. Operating leverage depends on fixed cost. Higher operating leverage means profits will be magnified, losses will also be magnified. Lower operating leverage means, relatively speaking to some other company, the profits will be magnified, but not by as much as the other company did. And this is your operating leverage concept. Now remember, from an operating leverage perspective, you may have to calculate a formula. Percentage change in EBIT divided percentage change in sales. This is one formula to calculate operating leverage. How much is your EBIT change for a percentage change in sales? The other way to do this is quantity multiplied by price minus variable cost. You can calculate what is your quantity multiplied by price minus variable cost, and you can also adjust it for the fixed cost. So if you have been given quantity, you can calculate operating leverage using these variables also. Mostly from an exam perspective, you may be asked operating leverage or financial leverage numericals also. So ensure you are able to do this from a numerical standpoint also. Interpretation is very simple. Higher the fixed cost, higher the leverage. Lower the fixed cost, lower the leverage. Sorry, so I forgot to complete this. Q, quantity into price minus variable cost, divided by quantity into price minus variable cost minus fixed cost. Okay. And remember, because I'm multiplying by quantity, these are all per unit numbers. This price and variable cost are per unit. Fixed cost is total fixed cost. Let's call it TFC, total fixed cost, not per unit. So you can use either this formula or you can use this formula. You should get the same number on operating leverage. It depends what type of information has been given to you. Now, the same thing can work with financial leverage. Operating leverage was based on fixed cost, operating fixed cost. Financial leverage is based on interest cost. This is again fixed. Same concept, fixed interest cost higher, financial leverage higher. And if financial leverage is higher, your profitability will again change. Formula for degree of financial leverage, DFL. Let's call it DFL, degree of financial leverage. Q into P minus V minus fixed cost or total fixed cost divided by Q into P minus V minus total fixed cost minus the interest cost in the denominator. Or you can write degree of financial leverage as percentage change in profit after tax for percentage change in EBIT. Both formulas should give you the same number. So this concept is largely based on interest, and which is now what we have done in our question. We have said company A is financed with 80% equity, 20% debt, 40% equity, 60% debt. Now you have debt. Because you have debt, there's interest. And we are saying firm A has interest expense of 2, firm B has interest expense of 9. This company will obviously have higher financial leverage because the interest expense is higher. And we said higher fixed interest cost means higher financial leverage. Let's try and work numbers. See, firm A, which has a $2 interest expense. So operating income has been given to us, EBIT has been given to us. Decline in EBIT, increase in EBIT. Whatever happens to your EBIT, your interest expense won't change. It is fixed. And therefore, if your return on equity declines or your return on equity increases. Declines by 9%, increases by 9%. But firm B, which had a higher operating leverage, will show you more variation. For a company which had $9 of interest and operating income is the same, 30 for both of them. The only difference is because there is a higher interest expense, the return on equity decline is also more and the increase is also more. So any business which has very high interest will have a higher financial leverage. Any business which has a very high fixed operating cost will have a very high operating leverage. Think about it. We are doing this class, and let's say I paid 1,000 rupees for the internet and the tools used to conduct this class. For me, the fixed cost is 1,000 rupees. Now, after this, if I teach one student or if I teach 100 students, my operating leverage is very high. Any incremental student we add to the session, it all straight away goes to profitability because the fixed cost is not going to increase. But if there are no students, that is also going to hit the profitability and I will have a very higher loss also. So the leverage concept is purely based on fixed cost. And fixed cost could be of two types, as I said. You could have operating fixed cost or you have interest fixed cost. Operating fixed cost gives you operating leverage. Interest fixed cost gives you financial leverage. It has a benefits on both sides. It will magnify profit and the disadvantages, it will also magnify loss. In good cases, this will work for you. In bad cases, this is going to go against you. Fairly comfortable? Questions? Okay. Really good. Let's take a break. I just overshot on the timing here, but that's okay. I just wanted to finish this part before we move to the next set of discussion. We'll keep it short, I think. We'll keep it to a 10-minute break for today. I have some content to cover because tomorrow is a test scheduled for you. We'll keep it a short break, 10 minutes. I think we'll assemble in another 10 minutes. 12:50 IST. Yep. Okay, we move then to the next set of our discussion on today's agenda, which is approach, or what is called as Modigliani-Miller propositions. And there are two propositions from Modigliani-Miller, two with the taxes and two without taxes, right? So now, what are Modigliani and Miller's proposition here? Uh, so they are trying to explain a concept about capital structure, and they are saying that capital structure, whether it is relevant or irrelevant to the value of the firm, right? So does capital structure change the value of the firm? So the first proposition, they assume there are no taxes. Proposition one with no taxes, and then we will have proposition one with taxes also. So they say if there are no taxes in the world, capital structure is irrelevant. Capital structure has no effect on the value of the firm. But while suggesting this, they make some assumptions. What are these assumptions? They are making an assumption that we are in a perfectly competitive capital market. Investors have rational expectations, no taxes, borrowing and lending can be done at risk-free rate, and no agency cost. Now, the idea is most of these assumptions are unrealistic, right? Which means in real world, they don't hold valid. They're unrealistic assumptions. But let's for now assume that this is all correct. And there are no taxes obviously in the system. And if there are no taxes, the capital structure is irrelevant. When I say capital structure is irrelevant, value of a firm which is levered. Levered firms means firm which has debt and equity both will be equal to a firm which is unlevered, right? VU means unlevered, and unlevered means only equity. So they say in proposition 1, if there are no taxes, capital structure is irrelevant. So whether you take debt or you don't take debt, your value of the company will be the same. And that is as simple as proposition 1 with the assumptions in place. Proposition 2, again without tax, the cost of equity and leverage proposition. So they say that cost of equity will rise linearly as the proportion of debt financing increases in the corporate structure. So they are saying if you take 10% debt, this is your cost of equity. If you take 20% debt, this is your cost of equity. If you take 60% debt, this is your cost of equity. So they are saying if you keep taking more debt, your cost of equity will keep increasing. Hence, the benefit of using more debt as cheaper source of finance is offset by the rise in cost of equity, resulting in no change in WACC. So although you are taking debt and you are saying that the cost of debt is the same, it is this. Your cost of equity keeps increasing. Therefore, your weighted average cost of capital does not fall, it remains flat. So their idea is you take more and more loans, your WACC is not going to fall. Rather, your WACC is going to remain the same because your other component equity is going to increase. And WACC is a mix of equity and debt. The assumptions to make this proposition are perfect financial world again, perfectly competitive capital market, investor have rational expectation, no tax, no bankruptcy cost. Once again, ideal world assumptions. So in the two propositions, proposition 1 and proposition 2, what is their thesis? And maybe we have a table to explain that, summarize it for you. I don't know. Yeah. Without taxes, what is their thesis? The first proposition is capital structure is irrelevant. Value of levered firm is equal to value of unlevered firm. Second proposition, without taxes, cost of equity will keep increasing if you keep increasing the weight of debt. If you keep borrowing, your cost of equity will keep increasing linearly. That is their two propositions which we just read. Modigliani-Miller proposition 1 and Modigliani-Miller proposition 2 without taxes. Example. Assume that a corporation has all equity capital structure, all equity, no debt. The company has, yep.
May I just interrupt you to back to the propositions that or the thesis? Sorry, the thesis. Sorry, the table with the thesis.
Yes, absolutely. I will just go to the table. Yes.
Yeah. Would you mind if I would add a, let's say to the second thesis, saying that the cost of capital increases because of the debt and the WACC and the WACC maintain the same, and the WACC maintain or keep maintain the same. Yes.
Correct. So the logical sequence is if a weight of debt keeps increasing, your cost of debt remains unchanged, but your cost of equity linearly increases. And therefore, overall, the WACC remains unchanged.
Okay.
Which is why we plotted this line where we said WACC remains unchanged, cost of equity keeps increasing, and cost of debt obviously is flat. It is not changing at all as you're borrowing more and more debt.
Okay.
Okay. How do we mathematically prove this? So we say a company has all equity capital structure, 100% equity. expected cash flows from the business are 5,000 euros and the cost of equity is 10%, which is also its wacc, since equity is the firm's only source of capital, right? If you don't have debt, if debt is zero, then wacc is basically equal to your cost of equity because 100% is cost of equity. For simplicity, we assume that all cash flows are perpetual, which means you keep getting 5,000 euros forever, every year. So the value of the firm in that case is 5,000 divided by 10% to 50,000 euros. Because this is infinite cash flow, we are just using A upon I or A upon R as an equation. It is a perpetuity. In time value of money, we read a word called perpetuity, a perpetual stream of income. And if you have a perpetual stream of income, which is 5,000 euros divided by the interest rate I, and you will get what is the value of that perpetuity. So the value of the company is 50,000 euros. Remember, this was 100% equity. Now let's change the proposition. Let's say if the company plans to raise 15,000 in debt at a cost of 5% and use the proceeds to buy back and reduce its outstanding equity by 15,000 so that your total capital remains 50. You have to compute cost of equity, wacc, and firm value. So you are saying now I will have weight of debt as 15,000 upon 50,000 and weight of equity as 35,000 upon 50,000, because 15,000 rupees will be bought back, shares will be purchased back. Cost of debt is 5%. Cost of equity remains at 10%. There are no taxes, so we are assuming no taxes. So what is now our cost of equity and weighted average cost of capital? We are saying nothing changes. We are just redoing our capital structure. Now, given we are borrowing debt, my cost of equity will be based on the equation we just saw, R0 plus R0 minus RD into debt upon equity, where R0 is your original cost of equity. Your original cost of equity was 10%. So you are going to substitute 10% here plus 10% minus 5% into debt 15,000 divided by equity 35,000. And you're going to solve what is the new cost of equity, because now you have borrowed debt. So the cost of equity should increase. This is old cost of equity. Because you're borrowing money, your cost of equity will increase. Equity is becoming more risky. So now you're saying with this 10% plus 5% into 15 by 35, my cost of equity is going to change. And then this cost of equity multiplied by weight of equity plus weight of debt multiplied by cost of debt should give you the wacc. So if you look at it, my new cost of equity is 10% plus 10% minus 5% into debt by equity is 12.143. And now the wacc is weight of debt multiplied by cost of debt, weight of equity multiplied by cost of equity new is 10%. So this is exactly what we were talking about. When the company was unlevered, no debt, 100% equity company, your cost was 10%. When the company is levered, which means debt plus equity, your wacc is still 10%. So although you borrowed more debt, Because you borrowed more debt, your cost of equity went higher from 10 to 12%. And therefore, the benefit of debt was not realized and your WACC stayed constant at 10%. The proof to the graph that your cost of debt remains the same, your WACC remains the same, your cost of equity increases if you borrow more debt. Now let's also prove that the value of the company also remains the same. Earlier, if you remember, the value of the company was 50,000 euros. Now the new company. Because you have debt, you will have to reduce your cash flow. You are going to say, I borrowed 15,000 euros of debt at 5%, which means I have to pay to my debt holders 750 euros. So cash flow to my equity holders will be 5,000, which I initially had, minus 750, 4250. So 4250 should be now divided by cost of equity. Value of equity is 35,000. Value of debt, we already knew 15,000. You add the two up, your value of the firm remains the same, which means value of the levered and unlevered firm also remain the same. If there are no taxes, so mathematically you can prove both the propositions and you can say if there are no taxes, the value of the levered and the unlevered firm will be the same. And the WACC is also going to remain the same. The cost of equity will increase, but the WACC will remain the same. Now, let's introduce taxes. Let's say there is tax, which is the reality. There is a tax. If there is a tax in proposition 1, where we were saying levered is equal to unlevered, now because there is a tax, the levered firm gets the benefit of tax. The value of the levered firm is equal to the value of unlevered firm plus T multiplied by D. The tax shield is something that we are talking about here. We are saying the tax multiplied by D, which means we are giving it the tax shield, where T is your tax rate and D is the amount of debt you have borrowed. So the only difference between debt and equity is tax exemption on the interest payment. Debt gets tax benefits. Hence, with debt, there is additional savings of tax called as tax shield, which adds to the value of the company. So your equation changes from this to this. No taxes with taxes. And we'll mathematically prove that in a minute. So this is the modification to proposition 1. Proposition 2 modification. We were saying WACC is going to remain the same. Now we are saying WACC is minimum with 100% debt. You remember the graph which was like this. Cost of equity, WACC, cost of debt. That graph has now been changed from this straight line to the line that you see here. We are saying the WACC is going to reduce with 100% debt. As leverage increases, tax shield provides debt and increases, causing WACC to decrease. So WACC is minimum when 100% is funded by debt. And obviously, if you're going to fund 100% with debt and you will have lowest cost of capital, the value of the firm will be maximum in such a case. Let's prove both of them using an example. Recall from the previous example that the annual cash flows to the shareholders were 5,000 euros and the cost of equity was 10%. As before, Gerard is planning to issue 15,000 euros of 5% debt to buy back the equity. Now let's make only one change. Assume there is a corporate tax rate of 25%. That is the only change we have made. So the after-tax cash flows now are 3750. You will have to pay taxes. You cannot have 5,000 completely to the shareholders. Your shareholders will only get 3750. So if you divide 3750 by 10% cost of equity, the value is 37,500. Let's calculate cost of equity, WACC, and firm value for this. First, value of unlevered firm is 37,500, no debt. But value of the levered firm will be addition of T into D. Tax rate 25%, debt of 15,000, 41,250. And value of equity therefore is 41,250 minus 15,000, 26,250. So we are saying that the value of the levered firm is higher than the value of the unlevered firm, 37.5 plus T into D. 25% tax rate, your debt number at 15,000. Cost of equity equation also gets a modification, R0 minus RD, cost of debt. The only modification is now put tax in between upon debt divided by equity. This was the missing element in the previous discussion we had. Now we have adjusted that for 1 minus tax. Cost of equity 12.143. So your weighted average cost of capital now reduces to 9.091%. Weight of debt, cost of debt, 1 minus tax rate, weight of equity, cost of equity. Cost of equity, you know how much is your equity. Debt, you know how much is the debt. Total of both is here. Tax rate 25, cost of debt 5%. So WACC changes to 9%. And with 9%, we do the proof that the value of the levered firm is 41,250. Take the cash flow, divide by 9%, value of the levered firm is 41,250. So when you are going to do a with tax assumption, you are going to assume that the WACC is minimum with 100% debt. And if WACC is minimum with 100% debt, the value of the company is maximum there. Value of the levered firm is unlevered plus T into D, maximum value when debt is 100%, and value of the WACC is minimum when debt is 100%. Adjustment is this to the above formula, that the one you read here. And adjustment is this to the formula you read here. So Modigliani-Miller have provided two theories or two propositions, proposition 1 and proposition 2, and both of them are with one with taxes and one without taxes. However, there is a concern. What happens is, if this was so easy that everything with 100% debt could be managed, then the world would have been a different place. If you're going to borrow so much debt, there is going to be a point where you will be in a financial distress situation, because excessive debt borrowing is also catastrophic for the business. And that is what the next theory talks about, static trade-off theory. This theory proposes that there is an optimal capital structure. The word is optimal capital structure, after which the benefit from the tax shield is less than the cost of distress. So this equation is what we already read, but it is saying that after a moment of time, let's say this, if you keep borrowing more debt, then your distress will start increasing. Your cost of debt goes up. And if cost of debt goes up, then the WACC, which was supposed to decline, does not decline. Rather, the WACC also starts increasing on the higher end. So the value of the levered firm, which was supposed to increase because of the tax shield, after the optimal capital structure, if you keep borrowing money, the value of the firm starts declining because there is a cost associated with financial distress. If you take excessive loans, your company can go into a financial distress position or a bankruptcy position. And in that bankruptcy position, we are saying that the value of the company or the business will decline. So we need to find what is this optimal capital structure. Every company has to figure out what is this optimal capital structure. This is like theory of diminishing marginal returns. You get benefits up to a moment of point, but after that, the things decline if you keep taking additional stuff in. So the optimal capital structure can be decided based on a target. You can have a target capital structure. Your actual capital structure may not be the same as the target capital structure. Today, you may have a very different capital structure, but in future, you may target a different structure. Today, you may say we have 10% debt, but our target capital structure is 0% debt. So potential exploitation of short-term opportunities in issuing debt or equity. Changing market values of debt and equity can also change your weights, right? Let's say your equity goes, you had 10 rupees of debt, 90 rupees of equity. Therefore, 10% weight of debt. Now, what is happening is your market value of equity went to 900. Your stock price multiplied 10 times. So now you are actually at 1% weight of debt because now you only have 10 rupees debt or $10 of debt out of a proportion of $910, where fair value of equity jumped 10 times. So changing market value of debt and equity can also change your capital structure. And transaction cost and minimum deal sizes may be too high to justify frequent rebalancing. Sometimes you don't want to rebalance because the cost of rebalancing is on the higher end. Determining target capital structure is often set as a range of value rather than a specific value, and usually computed using book value of debt and equity given potential fluctuations in market value and much focus by third parties on book value. So most of the time when you're setting up a structure, you will set it based on book value because your market value will keep fluctuating. But while doing all our calculations, we use market value. You can also look at what is your comparable company capital structures. How are the other companies in the business doing with respect to their capital structure? And if you want, you can copy their capital structure or align with their capital structure. Now, these capital structure that are also observed in the world, right? Like there's a cost of financial distress we talked about, very high compared to the business. As the leverage increases, the profit probability of distress also increases. Hence, this acts as a deterrent to high debt structures. What are the costs? The costs associated are direct and indirect costs. Direct costs associated with legal cost, administrative fees, bankruptcy related fee. Indirect, your customers, suppliers, investors lose faith or credibility for you. Agency cost is the principal agent problem we talked about in corporate governance. Agency costs exist because of the principal agent problem. Managers are supposed to be acting on behalf of shareholders and only in their interest, but they have incentive to act in their own interest also. They should only act in shareholder interest, but they start acting in their own interest. To check this, shareholders incur a cost called agency cost. What is this agency cost? You basically appoint sort of an agent, and that agent will have monitoring costs, bonding costs such as insurance to guarantee performance, residual losses. These are all agency cost. This is the cost associated with the agent, which are the managers. Managers are sort of an agent for your shareholders. They are appointed so that they can take care of the business. In a highly leveraged system, it is believed managers won't have enough free cash of their own to spend, hence they tend to be more disciplined. If you have debt in the business, you will pay that debt, and therefore very less free cash available for management to spend. There's also a cost of asymmetric information, where we say information gap between management and share or bondholders create cost. Management, while making financing decisions, gives out signals. For example, if you are issuing equity, if you're selling your shares, that means management thinks equity is overvalued. You're selling overvalued shares. While raising debt means it is confident of paying off debt and is taken as a positive signal. That's the market's way of assessing or reading the information. In capital structure also comes a pecking order theory, which we already talked about. The pecking order theory means lowest cost of capital in the following pecking order. First, your internal source of funds. This is your internal source of funds, retained earnings, debt, and followed by equity. The signal sent to the market becomes louder as we move from top to bottom of this pecking order. Perfect. Questions? So it's a very important reading, I think, on capital structures. There are a lot of questions on capital structure that can come from what we just read in terms of Modigliani-Miller, in terms of proving the mathematics or the formulas out there. Uh, Focus on it. I think it's important from a corporate issuer perspective, and even from a financial world perspective, a lot of these things do carry with you as you move forward.
Sorry, will you upload all this material today?
I will communicate this to the team. I'm sure they can send it across to you. I will pass on the message right away to them. Just give me a minute. I'll just drop a message before I forget. Done, sir. I've dropped a message. Oh, yes. Perfect. Let's move then to the last part of our syllabus, which is business models. Now, this is largely theoretical, helps you understand what are the different types of business models from a business perspective or a corporate perspective. Now, a business model provides specifics on how a corporation intends to generate revenue, whether by selling a product, service, licenses of a service, or selling a service as a product again. It all depends what is your business model. A successful business must offer a good or a service, attract clients, provide the good or service, and turn a profit. More simpler or more easier said than done. Company's business model therefore outlines how it either currently does or intends to achieve this. And a financial plan which is prepared parallelly is different than a business model. It will include a forecast, an estimate for revenue and expenses, as well as strategies for funding the organization. So when you think about a business, you create a forecast and then you realize, okay, I'm running short. I need money. How do I get this money? Is your financial plan going to put forward? What could be the business model framework? Identify what is the product or service. This is what you should also do when you read businesses. How are your products and services different from competitors? How do you think you're going to deliver this or create this? Prospective clients. What is something that we call as market sizing? Why will clients purchase? How will you find new clients? So these are typical questions to be asked to a business, right? And this is not an exhaustive list. For example, who is your vendor? How are you going to source raw material? Can you import raw material? How will you hedge your currency risk? Those are again additional questions which are not on the list, but you will have to think and add. What is CAC? Like your customer acquisition cost. How can you minimize the CAC? Very important question. How long can the customer stay with you? Is the customer sticky or will there be an attrition of the customer? So whenever we look at a business model framework, we need to ask n number of questions. Questions associated to sales, cost, profitability, taxes, financing, almost everything goes into it. Every business, when you do these questions or ask these questions, try and understand the features of the business. For example, customers. As I said, how much will it cost to acquire a customer? How long will the customer be with you? Is it a B2B customer or a B2C customer? Product differentiation. What is so different about the product? What need do you fulfill? Are there any competitors? Is your product a substitute or a complement? Your sales strategy, online, offline, omni-channel, through intermediaries like retailers, wholesalers, agents, or franchisees, and key assets and suppliers like expertise or skilled employees, patents, softwares. So key assets, a lot of times, even the top management will be part of your discussions. Will the top management continue with the firm? How long? You need to understand that. Because if the top management leaves the business, there is a risk that is on the rise here from the business perspective. Pricing and revenue model. I think a lot of you are already aware about what a pricing is. The point is, can there be price discrimination that a company can do? Can a company charge different pricing to different customers? And if yes, how does that benefit? So yes, price discrimination is possible. You can maximize profits by setting different prices for different customers or identifiable group of customers. Tiered pricing, different price levels are set for varying quantities or service tiers, like higher tiers offer more features or benefits. So you can have tiered pricing. Let's say you order a million volume, I'll give you a different pricing. If you order a 10 million volume, I'm going to give you a different pricing. Dynamic pricing, like what airlines typically do with tickets. The prices fluctuate on real time. You know, gasoline prices in some of the countries, the gasoline prices are dynamic. They keep changing on an hourly or a timely basis. They're dynamic, determined by the market factors. Value-based pricing. Pricing is determined by the perceived value to the customer rather than the cost of production. And auction pricing. Pricing is set through competitive bidding, where buyers determine value through the auction process. Perfect. Questions around this? Anything? Obviously, plain vanilla theory. I think most of it is generic common sense, general knowledge, but I think still part of the syllabus, so we should talk. Okay. Now, pricing for multiple products. Bundling is an approach, right? A lot of times when you buy Microsoft Office, you can say, I want a Microsoft Excel. The pricing could be different, but the Microsoft Office may say, okay, why don't you take a bundled full Office suite of products? Take a full suite and I can give you a better pricing. So bundled offering. Razor and razor blade pricing. That the word is you sell a low price equipment with high margin add-on or follow-up purchases. For example, razors, low margin, but the razor blades that are going to come is high margin product. Again, printer and ink toners, right? So complementary products where without selling one, you cannot have any use of the second. Add-on pricing, selling optional services or add-ons with high margins after the initial purchase is made. What are the other pricing models? You nowadays look at penetration pricing, where a lot of companies offer products for free to penetrate a market or to get entry into a market, get some market share. Subscription model, very common. A lot of us have seen subscription models with softwares. Premium pricing, initially a free offering, but eventually there will be a pricing to convert to a freemium or premium model. Leasing, licensing, and fundraising, and hidden reserves or hidden revenues rather. When we say hidden revenue, credit cards, I think, are one of the best ways to look at it, right? If you don't read the terms and conditions properly, the bank may end up making some revenues of you, which were not clearly explained or written in big bold. So there is a possibility that the companies can generate revenue by other means. Always distinguish between models. For example, Verizon covers the initial cell phone subscription fee and recovers cost over the life of the cell phone contract. This is the example of razors and razor blade model. Initial cost is very low to enter into the contract, and razor blades higher ongoing contract fee model. So initially, some of us may subscribe to some apps, may look very low or very low cost app, but eventually perhaps there's a possibility that you may be part of some other subscription. Google search is free for users, but revenue is generated through advertising. This is the example of hidden revenue. Value proposition. A firm's value proposition refers to how customers will value the attributes of a product or service, leading them to purchase it. So if there is no value proposition, generally customers may not be happy to even look at the product. And the value chain therefore refers to how the firm executes its proposition. Any break in the value chain will disable or will not help the firm to deliver the value proposition. By contrast, the supply chain refers to the process involved in creating a product. The supply chain is your backend. Value chain, to deliver the value proposition, is what happens between you and your customer. What is the value chain, and is there any missing link in the value chain? Sometimes your customer service associate is part of the value chain. You have sold a product was a very good value product for the customer, but the customer relationship manager guy or the installation guy who had to install the product did not do a great job. In that case, although you delivered a product, but that product eventually, the value proposition was not entirely delivered because of the installation was not done appropriately or the experience was not up to the mark. The other business models, private label producers. Sometimes businesses sell products under their own brand name, obviously very high margin. If you look at Amazon, they have some products which are called as Amazon Basics. Those are Amazon's own products or Amazon branded products, very high margin product for Amazon. Licensing agreements, you license characters, especially comic characters. You will have, Captain America, Marvel, a lot of these will be licensed, Harry Potter, and merchandise based on these licensing agreements can generate revenue for the author or the movie house. Value added reseller model, provide installation, service support, or customization for complex equipment. You are only reselling a product, but as part of your reselling services, you are offering services associated to install or commission the entire product. Along with business models, nowadays there are a lot of e-commerce related terms that you will hear around. Affiliate marketing. One business pays a commission to another for specific marketing outcomes like page views, leads, or purchases. This is more or less visible in digital marketing as a industry. Marketplace, like all your e-commerce portals, and Amazon being the largest in that category, provide a venue for consumers and sellers, but do not own the products that are being offered. Aggregators offer a marketplace while also conducting its own brand name sales of goods and services. Network effect, I think, is the best example of Microsoft Excel. This is a product which has a network effect. The rise in the network value as the user base increases. Microsoft Excel's user base is such a large user base that it's virtually impossible to replace Microsoft Excel. A lot of companies like Google, Apple have tried their spreadsheet softwares, but the value that Microsoft Excel has created by network is virtually impossible to replace at the current moment. And that is the network effect we are talking about. This is also visible in social media based apps. Crowdsourcing, user contribution are used for generating data. And I think Wikipedia is your perfect example for crowdsourcing. Again, these are all different types of business models. But all the businesses bring risk with it. External risk factors that will affect the business risk and the cost of capital involve economic conditions, demographic changes where the society itself changes, and legal, regulatory, or political changes. So there are certain industries which are created because of societal changes. Like if the women population keeps going to work, increasing people joining the workforce, then you need creche for babies. Then you need a new industry to be created where babies could be managed while the women are on their workplace. So that's a demographic change which a lot of economies are witnessing. With external risk factors that affect your business, there are also some firm specific factors like competition, stage of firm, or greater company risk when raising financing cost or limit the amount of funding available. So it's not always that external factors are going to impact you. There are also firm specific factors which contribute to the risk of the business. And this may also include management, right? If a management or a key personnel from the management leaves, there is also a risk. Business models that can reduce the amount of financing required, right? So if you want to reduce the amount of financing required, which we typically say very low capital intensive business, you can have an asset light model, which means don't buy assets, lease them. Lean startups, which means much of the work done is outside the firm. You are just doing one or two key aspects of the business. Pay in advance models like insurance or retailers, where you get money upfront. Because you get money upfront, you don't need financing. In insurance, I pay my insurance premium upfront annually. So insurance company already has the capital. They don't have to worry about capital because they get it in advance. From a business risk, macro risk resulting from factors which we already discussed, like economics or economy, politics, and law, as well as other risks that have an impact on all firms in a given nation or region, such as demographic shifts over time. Whereas business risk is variability of EBIT from factors that we discussed, like operating leverage, corporate governance, or demand for the product, etc. Industry is generally impacted by some of the industries are cyclical actually, like air conditions. They generally sell in a specific season when there is summers around. So again, industry is also cyclical. Steel cyclical, metals cyclical. If the economy is in a recession, then you're looking at a cyclical industry if the industry is not doing good. Regulations and competitions we have talked about repeatedly are factors that impact the business. It will impact your profitability. Perfect. So I think that is all that we have today. The last reading obviously is theoretical, as I said, not much, I think pretty generic in terms of what CFA puts forward. Few of the words are interesting to talk and hear. More than that, I think the focus area should be, the second reading, which is capital structure related theories and Modigliani-Miller especially. A lot of questions do come up. Leverage questions, again, very important. So the chapter itself is extremely important. Focus on it. And I think the first one, real options, interesting. You can expect questions around real options, right? So I think the first two are the core concept for the day. And the last one, I think, is it's okay. I think that I'm sure you can manage that with your general understanding about the business as well. With this, I think we wrap corporate issuers.